Welcome to the Real Vision Daily Briefing. It's Thursday, February 10, 2022. I'm Ash Bennington. Today, I'm joined by Tom Thornton, founder of hedge fund Telemetry. It's a big day out there. Markets in motion. U.S. equity markets selling off. I'm looking at the closing numbers right now. S&P 500 hovering just above the 45 handle, 45.04, off on the day, down 1.81%. NASDAQ down more than 2% on the day, closing out the trading at 14,185. Dow Jones Industrial Average also off almost 1.5%, closing at 35,241. Tom, obviously a lot happening right now. Hot number coming in on the CPI print for last month, 7.5%, highest number in 40 years. So much going on, lots happening in the bond markets. How do you contextualize it all? How do you make sense of it?
Yeah, today was just an extraordinary day. I mean, I think a lot of people started to price in a lighter CPI number a few, like this last week. I heard it from a lot of people that, oh, it might come in soft, but oh, next month is going to be really high. But it came in very, very hot. And so 80% of the components were rising more than 3%, and then 65 of the components rose more than 4%, and the rest were 10%. That's just extraordinary. And bottom line is the Fed is clearly behind the curve. And I think we have a chart that we can show that it's pretty obvious looking at the 2-year and the Fed funds rate.
Yeah. We should say we're talking about these on a year over year basis. Significant, obviously, moves on a monthly basis as well. So walk us through the chart, Tommy.
Well, it's simple. It's just it shows the 2-year is in blue and the Fed funds in yellow, and they've been correlated in the past. And now the Fed is clearly behind the curve, and I think you can see that with base metals, grains, other commodities that are just going through the moon. And that is a problem. And that's why Bullard came out today, midday, around lunch, right before the 30-year auction. Good timing. And said that he's for a 50 basis point hike and for basically 1%, being at 1% at least in June. And the odds, which we can look online, of what the 50 basis point hike could be went up to 75%. It was around 25% this morning before the CPI. But this CPI is going to get even hotter next month because one of the components is gasoline, and it's not crude. I always thought it was crude, but it's gasoline. And gasoline futures have gone up, well, a lot since December, and that's why the January report we just had was higher because of Biden's SPR release. But now it's
strategic petroleum
even higher. Yes. So now we're going to see it even higher, and rents were going up a lot higher as well. And that to me is really concerning. And it's hitting every single consumer, every single way. You can't really get away from any of the, the food prices went up. Still car prices are still very, very high. Used car prices might be moderating, but still, if you look at the Manheim charts, they're just off. They're crazy. So if you have a used car, sell it now. So I think right now the Fed is in a bit of a panic mode, and I called my note today a Bullard in a China shop because basically I was thinking to myself, with all the stuff that's going on, you have inflation that's a runaway, you have rates rising, you have equity volatility, and the Fed funds is still zero, and they're still buying. There's QE is still happening. There's some talk that there could be an intermeeting move. That would confirm my thesis that the Fed is completely in panic mode.
Yeah, we have not seen a move on rates intermeeting for some time now. I should also point out, looking at the numbers from this morning, Food costs up 7% year over year on a month over month basis, Tom, up 0.9. In other words, they've been up 0.9% in a month. That is brutal.
Yeah, imagine if you are a restaurant and you have to buy those food products across the board. You're going to have to raise prices to your consumers, which Chipotle's CEO on their conference call said that he could raise prices on their, the burrito bowls and the tacos and everything like that. But, seriously, it's going to come to a point where the demand starts to drop off because of the higher prices. And that's how inflation works. It just
Yeah.
starts to see the slowing of various aspects of what the consumer is buying. And yeah, I just shudder to think where it could be in the next month. And remember Bill Ackman a while ago, it was probably a month ago, was saying the Fed needs to restore credibility and raise 50 basis points in March. And people sort of laughed at his comments, but I thought, he might be onto something. And now 50 basis points is consensus.
Yeah.
So I think right now we're going to have um, a really pretty difficult couple months until we get some more confirmation of what the Fed is going to do.
Yeah. Let me just run through one other thing. We talked about the equity markets at the top of the show. I also want to talk about fixed income here. Right now, U.S. Treasury yield up to one spot 613%. I'm just eyeballing it. It looks like up about 14 basis point move in one day of trading.
Yeah.
Obviously, pretty considerable. Go ahead, Tom.
Yeah, the 2 year, just with that chart that we had was crazy. I will say that I've had a like 198 and 10-year target, and we achieved that, and we went over 2%. And I keep thinking, it's just going through my head, the Rob base it takes two to make everything all right. No, it's not. It's not all right, because I think that's why tech stocks and small caps and others that are reliant on lower rates started to really start to sell off after Bullard's comments.
Yeah.
But I do think that you could have a little bit of a reprieve in the rates market. I think the 10-year on the daily time frame, if we can throw that up there, it is getting a bit exhausted with the DeMark indicators. We've got the sequential, the combo, and we're at the upside wave 5 price objective.
Yeah.
So there's the chart there. And the other thing is, if we're going to have a back off in rates, and we see the rates, come back down under, let's say, under 190 on the 10-year, I think the intermediate term target that I have on the weekly chart, and there are still upside DeMark countdowns in progress, that's looking at 2.45% on the 10-year. So it could be a bit of a risk off, go to bonds in the next week if the equity markets break to new lows, which I think is entirely possible, and especially since the way a lot of stocks have traded recently.
Yeah. 10-year U.S. Treasury right now, price to yield 2.054, call it 205 basis points. Also, we should point out 2's10 spread on the day. Give me a second. I lost that screen, but it is significantly.
43.
Yeah.
Yeah,
3.3 is what you
crazy.
say. Yeah. Obviously, some significant compression here on that flattening of the curve. Something that suggests, again, the exact point that you've been making since the top of the show, Tommy, Fed behind the curve.
And the thing that's really probably the most concerning thing with the rates market is the rate of change is so rapid,
Yeah.
and it's just running over traders. And to think about how much issuance in the high yield and the investment grade has been issued with the ultra low rates in the last couple of years.
Yeah.
I mean, it's staggering. Everybody used to talk about, like, oh my God, the rates market or the credit markets are just so firm and there's just so much demand. But those are starting to waver, and the credit spreads in Europe and in the US are starting to blow out. The CDX spreads are starting to blow out, and they're not at necessarily any levels that I could say match up to what we saw in March of 2020, but they're starting to look a similar way to the fourth quarter of 2018. And that was, we had a 20% pullback in the equity market. And I still think we could see 20% lower or 20% from the top. Maybe, maybe, I don't know. It feels pretty awful.
Yeah. By the way, as we talk about the broader macro context, I wanted to take a look at a clip from today. This is a conversation I had with Sri Kumar called No Way Out, Are We Headed to Stagflation? This is something that's running on the platform right now on all tiers, Essential, Pro, and Plus. And I wanted to take a look at this clip because I think it speaks to precisely some of the points that we've been discussing here. Let's take a look.
We do not have the political will to withdraw support. And I don't think we have the political will, because you can see that given a chance, the Biden administration will revive the Build Back Better and spend another $1.9 trillion to provide childcare, medical benefit, spend on climate change, all of that in coming years. It's only the gridlock in the Senate that's preventing that from happening. So the political will does not exist in the administration to do anything different from before. So what happens? Whatever happens with this Thursday number, overall, I think inflation is headed upward. Then you reach a stage when the Federal Reserve and the Treasury have no leeway but to tighten. And that is called tightening into a recession. So when the high interest rates have already caused the economy to turn down, which I think is what we are headed toward, the Federal Reserve will be increasing interest rates. They'll make it worse.
Sobering thoughts from Sri Kumar. Absence of political will at the Fed, tightening into a recession. And obviously, Sri called it on inflation. This was recorded 3 days ago. He completely nailed it. Tom, what are your thoughts about this broader context?
Well, look, the Fed's going to raise rates. I think the stock market's going to go lower because that's generally what happens. And I know the Fed, from the people that I talk to that have connections and one of Raul's good friends, the Fed is fine. Use that word fine with the equity market dropping some more. That does some of the work for them if the equity market drops. And we've seen a lot of people with the Fed put is a lot lower. Bridgewater's at 3,500 on the S&P. Bank of America's at 3,800 on the S&P. I think we could get into the, get a 3 handle on the S&P. I think it can happen, maybe in the next few weeks.
I mean, we're still up on the year, S&P, I believe. No, we're not. I think,
no.
Oh, we got to get the charts here. Go ahead. You say it.
You got to turn your monitor the other way. I know you do that with Bitcoin sometimes.
Yeah, maybe it's my Bitcoin optimism as we're flipping through charts here. Look, what is the potential floor for this? I think this is the point that you were making in terms of the Fed and their reaction to what point the equity markets give them so much agita that they need to step in. I mean, that's really the question here, isn't it?
I don't think the Fed, I think the Fed is not as focused on the equity markets as they are to controlling inflation. And that's a mandate by President Biden that was the first thing he said in that press conference a month ago. We've got to fight inflation and the Fed's going to do it. And he renominated Powell, and I'm sure he gave him a wink saying, I'm going to renominate you, but you got to get inflation down before the midterm elections. So I think that they can allow the stock market to drift. You've had 2 incredible, strong years. 10 incredible strong years. And if they allow it to moderate, it does some of the work for them. And, one thing I've been noticing, you have a lot of stocks that are down, some of these high-flying tech stocks and consumer stocks down 50% or more. And they get these, the buy the dip people come in, and then they break even lower. And Facebook was a good example of that. It had already been down significantly, and then they just booted their earnings and everything just fell apart. And then even after the big down move, the down day, it went even lower. And you're seeing stocks like Affirm today. I mean, that was just a mess where on social media they reported earnings, or their social media reported earnings, but I think they were wrong and they had to revise. And then the stock was halted like 3 times and it's just continued lower. And I'm embarrassed to say that I was short the stock at 150 and I covered it at a profit, but way too early because I think it's in $58 right now. So
So Tom, let me play a little devil's advocate here. Let's look at the numbers here for year to date on major U.S. equity indices. S&P 500 off 5.5%. Dow Jones Industrial Average off almost exactly 3%. Nasdaq Composite and Nasdaq and Nasdaq 100 both off between 9.33 and 9.89% respectively. These are not significant losses on a year-to-date basis. If you look at them on a one-year basis, obviously up considerably, 15.2% up on S&P 500, up 12% on Dow Jones Industrial Average. So this idea that that the Fed is not in the business of intervening to support U.S. equity markets, it's kind of easy to say that when you're only off 5% on the year and you're up 15% on a trailing 12-month basis. What happens when those numbers go negative? Do we have the political will to sustain a correction and even a bear market?
I think the main, I'll go back to this. The main importance for the Fed right now is to control inflation. That's it. And yeah, they'll come back in and give some sobering or soft comments about the equity markets and that they're there, but they've got to get the Fed funds rate higher and they've got to slow things. So that's really the big important thing. It's Greenwich. We've got a cat in a tree, I'm sure. You can hear the sirens.
Well, that's the point of that chart you showed, showing that the federal funds rate versus the 2-year and that mismatch. There's just no choice, it seems. But again, it sort of gives this point that perhaps we are in this between a rock and a hard place situation where what happens if the Fed does begin to hike and hike aggressively, looking something like Mr. Bullard suggested today, 100 basis points between now and July, and you start to see equity markets sell off. I just don't know if there's the political will. And, it seems like they're just left without a good option here.
Well, they painted themselves into a corner. So they have no good option at all. But the option that they have to take is to control inflation, because inflation it can be out of control. And slowing inflation, one of the ways they can do it is to raise rates, make it difficult to borrow, put pressure on corporate earnings, and the stock market comes down to maybe a more reasonable level. I mean, remember, the stock market is not cheap at this level here. The valuation is not cheap. And the mega cap stocks that have been holding this market up, those aren't necessarily bargains either at these levels. So
Right.
yeah, we've had the market down not so bad, but the rest of the market has been an absolute nightmare. But so if you go to the S&P chart that I think we have on here, it's a little messy, but I can explain pretty simply.
Go ahead.
Okay, so this is the S&P, and we had this first move down on the in January, and we had a DeMark buy setup 9, and this is a indicator that Tom DeMark created, and essentially it told us that we were going to have a bounce, and we had setup 9s across the board, and we even had a setup 9 in Bitcoin, Ethereum, and so everything has bounced. But my call has been that we would make a lower high wave 2. So essentially the first move down from the highs, that was wave 1. We'll make a lower high wave 2. And remember, in wave 2, or this is when everybody thinks that everything's going to be fine and we keep buying and everything's good. But the problem is, if we break the recent lows in January, we could be in for a deeper move. And I think my target is on there at just over 4,000. It could go even lower. I'm not, that's just a mechanical target that we use with the DeMark indicators. But the bottom line is if we reverse down and start to lose the recent lows, I think that the market could be down easily 10% from here.
10% from here.
Actually, 10% from the lows. Let's go from there. It could be get a 3 handle on the S&P.
Yeah. Tom, you were mentioning a little bit during the break what you're seeing in short interest numbers coming out yesterday. Give us a little bit of context on that.
Okay, one of the things that was really interesting, the first few days of the year, it started actually the last 2 days of last year, and then the first 3 days of this new year, all the prime brokerages, Goldman Sachs, Morgan Stanley, all their reports said that they're seeing the largest amount of selling of technology stocks from their clients. So basically, their institutional clients, they can track, how much Apple they have or how much, Micron technology they have, and they can see those sales. And so that was a first clue that basically smart money was trying to liquidate long positions. But as we moved down towards at the lows, and it was I think short interest was about 15 days ago when it was calculated. People were starting to short a lot more, and the Nasdaq short interest was up 5% for the last 2-week period. Now so what happens is it's 2-week lag time, and this bounce that we've seen off the lows has seen on the short baskets that I look at live from Goldman Sachs, Credit Suisse, those have been up significantly. In other words, all we've seen in this bounce is short covering. So when you see shorts, go down, they cover, and then if there's any more bad news with the absence of those shorts, there could be a vacuum lower because you don't have the natural buyer of the short covering. And so that to me is a bit of a concern. We do a bi-weekly webinar, and if you go on my Twitter, you can sign up for it. We're doing it tomorrow at 10:30 in the morning, and we'll explain a little bit more of what we're seeing. I think there's more large cap shorting right now because the dollar volume was a lot higher, and that might be also because the shorts that the big players are shorting are more liquid, and they want more liquidity on the shorts. And shorts, when short interest goes high, it's not necessarily always this short squeeze that's going to happen. You can have a short squeeze like what we've just had, and then those shorts stay short, and they actually are right. So they can be right. And we saw that in the beginning of the year in 2000. Shorts got squeezed in February, and then boom, it was lights out for the next couple months.
By the way, NASDAQ Composite, the worst performer on a trailing 12-month basis, 1.53%, and the second worst performer on indices on a year-to-date basis, minus 9.33%, exceeded in its losses only by the NASDAQ 100 at 9.89%, getting very close to correction territory on NASDAQ 100.
Well, the Russell is down 8.5% for the year, and year over year, it's down a little over 10%. And that's, we just had a bull market, and it's down year over year. And that's where there's been a lot of damage in the market, in the small cap, mid cap. I'm just looking at some other stuff here. Actually,
talk a little bit about
Bitcoin is down year over year. Do you know that? Sorry, I know. I don't mean to. You're Mr.
Yes.
Bitcoin.
Yes, it is a painful moment for us all.
I'm sorry. Well, you could be in the. I'm just looking up at one of my screens. You could be in the Hang Seng in Hong Kong. You're down 17.5% year over year.
It's off about $3,000. It's 40. It was at 47.9, I think, 12 months ago, and now at 44,135. But let me ask you this: something about a spread here. Talk a little bit about this, what's happening right now in small caps, because 1 year return S&P 500, 15.2%, as we said earlier, and then minus greater than 10% on the Russell 2000. This is a massive, massive gap.
Yeah, it's because in the Russell 2000, you don't have Apple, Microsoft, Google, and Amazon, and those guys have held up and masked all the serious carnage. I mean, I was looking at the Nasdaq
Yeah.
Composite percentage of stocks above the 50-day, 150-day, and 200-day, and they were like under 30%. So that's massive. But if you look at the indices and the weight of those mega guys, it's masked. And that's the problem I see. If the market corrects, people are hiding in those really good, solid, great companies. And I have nothing, bad to say about Apple or Microsoft or Google. Their numbers were great. Amazon numbers were good too. It's a little squishy here and there, but those first three were really good numbers, and people are hiding in them. And if all of a sudden we break to new lows, that hiding space is going to have some cracks. And that's typically of what happens when they start selling the best quality. And they sell the garbage first, and then they have to give up and sell their best quality at the end.
But Tom, what does that suggest about this, the challenge with the sort of the incredibly narrow gains that we've seen? Apple looks like up 27% on a trailing 12-month basis. What does it suggest when you see all of these very large cap tech stocks picking up huge amounts of these? I mean, these just significant 27% 12-month, while you have basically all of this concentration of capital in these big cap tech stocks, and you see these vast majority of small and mid cap stocks just getting hammered. I mean, what does that portend for broader equity markets?
It's the power of large numbers and the weightings, and there's really nothing you can do about it. And what will happen is you'll see cracks. And I think Amazon is a short. Facebook is in purgatory right now. I don't think Facebook will ever see new highs again, ever.
Hmm.
And I have fundamental differences with the way they run Facebook. Maybe they'll break it up and do something, but I don't buy into the metaverse plan. I think it's creepy, honestly. But it is.
I'm glad we have a lighter moment here today, Tommy.
Yeah, I mean, you're always going to get that with me. But the bottom line is, you start to see cracks in all of these big cap names eventually, and they can't all go up forever. And maybe they'll just see corrections. I've seen Apple correct 50% a few times in my career, and wouldn't that be great to be able to buy some of these great companies if they have a bit of a product transition or slowdown or demand slows, or the Fed really does what it needs to do? I'd love to be buying good quality. I mean, in March of 2020, I was on Real Vision, and I said the first thing I'm going to do is buy the best quality I possibly can in my portfolios, because they were just ridiculously on sale. And if I'm wrong, and let's say the pandemic lasted forever, which it did, but the equity markets didn't respond, I'd be fine holding Apple or Microsoft or Google or any of those. You just buy good quality when the markets get hit, because the garbage names, they're still going down. They go up a little, you lose the buy the dip people, and they have to sell, and that's fair market mentality in action.
Yeah. I want to throw in some questions here from our viewers. I want to do these two questions together, actually, because they're both talking about things related to the housing market. The first one comes to us from Mark from the Real Vision site. The question is, the cost of shelter is 33% of CPI. It's its largest component, and at only a 4% annual increase, it seems to be lagging reality. Where are home prices and rents, and when are we going to see double-digit increases? And the second one comes to us from Yo-Yo from the Real Vision site, who wants to know where home builders are going. So questions about pricing of the housing market and also about home builders. Tom, what are your thoughts right now in that space?
I have some thoughts. First, I think there was a huge pull forward with demand with the pandemic. And I've seen it here in Connecticut where you had so many people move immediately out of the city and they moved to the suburbs. And as you see behind me, I share my office. There's an office over there, but my office is shared with my wife, who's an interior designer. And I will say that her business has been incredibly, incredibly strong from this migration. However, with higher rates, you're going to see home builders have some problems. It slows housing traditionally with higher rates. And fine, they're not that high yet, but the 30-year mortgage is making a new high every day, it seems. So that will slow a bit of the housing market. The home builders also have an issue because their input costs for materials and labor are absolutely going to hit their margins hard. Now, there's still demand for housing and there's still demand for rentals, but there's not a lot of supply because all that demand forward occurred. So there's less houses, less rentals. So people are going to be able to charge more or ask more for their used houses or rentals. And that's the issue there that within the CPI. I think you're still going to see prices remain high with the scarcity of homes. And, but then you have the headwind of higher rates and the Fed, doing what they're doing, which will ultimately slow the housing market. A couple housing market shorts. I've liked the furniture makers. Williams Sonoma's great company, but that's probably overdone. Restoration hardware has come down a whole lot. I think Home Depot has been a big beneficiary of the housing migration and boom. And they could see tough comps this spring because last year was so strong. So, and input costs, housing, or labor and materials. So I think it's going to be tough on Home Depot.
Yeah. Tom, obviously, as we come to the close of this show, it's been a big day, an important day in markets, lots going on. Final thoughts, key takeaways, things that people should bear in mind as they leave this conversation.
Well, I think that right now we're in a difficult place in the market that many people have never seen in their life. And I was just a young kid when there was inflation in the world, and I didn't quite understand what happened or what was happening. But I remember my parents, it was tough on them, and it's going to be tough. Inflation is very tough on the low end of consumer. It's very tough on the middle class. I think it's going to be really hard on restaurants. They're going to have to raise prices. Demand's going to slow. This is a nightmare for the market, honestly, for the economy with high inflation. It's just hard to fix. And so I think there's a lot of mispricing and bad judgment with market participants right now, thinking they can buy every dip. And there will be squeezes, there will be moves higher, but right now I think you need to sell into strength. You need to hedge yourself with put spreads, index put spreads, or ETF put spreads. Don't be ashamed to not have yourself fully invested. That's not the worst thing.
Right.
And don't be on margin right now. I think it's a difficult time and things can change pretty quick.
But Tom, it's interesting. If you ask why they buy the dip, the answer is because buy the dip has worked.
Yeah.
And now we're in this moment where it starts to look like an inflection point, like a regime change, like something has shifted, like the sand beneath our feet is moving.
Well, the buy the dip mentality is not going to be, it's not going to stop over, the first move down. It tends to stop every time it fails. And if you look at so many stocks out there that people have tried to buy the dip and they just get run over on, it just gets more sellers come into a stock or an index. It's really tough. I've seen several bear markets, and there's a lot of opportunity, and we find opportunity on the long side all the time. But there's also great dispersion where you can short things as well and make money that way. It's tough to make money in a bear market, but it's not that hard to protect your assets.
Yeah. Tom, always a pleasure to have you. Great to have you on a day like today where there's so much happening in markets. Thanks for joining us.